Hello, and welcome to our private economic update for Q1. I'm Chanel, an assurance partner for PwC Private. Joining me today is James, our Senior Economist, who will provide us reflections after last week's RBA meeting.
Thanks, Chanel. Great to be here.
Wonderful. James, many of the CFOs I work with are currently focusing on mitigating the cost of debt, inflation, and currency fluctuations. Keen to hear your perspectives on the impact of RBA's recent rate cuts on these critical areas. Additionally, how do you see this play out in the private market?
Yeah, so as widely expected, the RBA delivered a 25 basis point cut in August to 3.6%. It was a unanimous decision. The bank noted inflation has continued to moderate, that it's down substantially from its peak in 2022, and it signaled further gradual rate cuts were ahead. The board also highlighted the heightened level of uncertainty was shaping their decisions. And I think really since the RBA's new structure was put in place back in March, its tone's been one of caution. It's been one of heavy reliance on key data releases before they make any moves. Going forward, markets expect another 25 basis point cuts by mid next year. If you want to know when the first will happen, keep an eye on the July through September labour force prints and the Q2 GDP data too. But for me, the bigger question though, it's not exactly when the first rate cut will occur. It's whether this softening in the labour market, whether a weak productivity, whether these force a faster and a deeper easing cycle. Or on the other side, if jobs remain resilient and that lets the RBA glide through this year and next.
And any thoughts on the currency outlook?
Yeah, there's been some modest downward pressure on the Aussie dollar as the bank has cut rates and signalled further easing. On one side, you've got kind of softening labour market and weaker productivity, with a likely cap upside risk. You've got downside support then from inflation as it's continued to moderate. But in the medium term, the story's all about China. China's growth momentum and demand for our commodities. At a global level, uncertainty, that'll determine whether investors at a macro level feel the need to go back into the safe haven of the US dollar.
James, you touched on weaker productivity. I found it interesting that the RBA has downgraded its medium-term productivity assumption from 1 to 0.7%. Treasurer Chalmers has said lifting productivity is the government's primary focus in the second term. And a key milestone in his agenda is Economic Reform Roundtable, which is currently underway. With that in mind, what is your take on Australia's productivity?
Yeah, so look, we can grow the economy, grow GDP by working more hours or just adding more people, but these have natural limits and they add pressure to things like infrastructure, housing. So our target should be creating more value from the same inputs so we can raise incomes, so we can consume more or just choose to work less. That's productivity, right? That's efficiency gains that lift living standards. And since 2016, Australia's seen virtually no productivity growth. Contrast that with the 90s, early noughties, annual gains typically started with a 2. And this downward trend, it's visible across many advanced economies, with the notable exception of the US. Peer central banks in the UK, in New Zealand, Canada, they've all lowered their long-run productivity projections. So the RBA's downgrade really reflects our experience of the last 20 years or so. And given it is a common phenomenon across advanced economies, we can point to commonalities across them. So slowing dynamism in business and in labour markets, weaker competition, and also the role of red tape and regulation. But even so, Australia still underperforms on some metrics. So if we look at GDP per hour worked, we're roughly where we were in 2018. In the same period, Europe, the UK, Canada, they've all grown by 1-2%. New Zealand, they're up by over 4%, and the US, kind of again an outlier at about 12%. So look, these gaps, they compound into wages, into profits, and ultimately our fiscal capacity too.
Right. So how would you go about boosting productivity? And is there a silver bullet?
No silver bullet, Chanel, but I'll offer 3 priorities. First, we've got to get businesses investing. So one way to make labour more productive is to give it more and better capital. So better technology, training, equipment. As a consultant, my output, if I had a fax machine versus a laptop with the latest Gen AI model, drastically different productivity. In Australia, annual growth in real capital per person has fallen from around 2% at the turn of the century to near zero today. So that's capital shallowing, and that drags on productivity.
So how do you drive capital deepening, getting more capital per person?
Yeah, it's two levers, right? You can look at the numerator, so the capital stock. You can encourage, incentivize investment, or look at the denominator, so slow growth in population. Since 2000, Australia's population's risen by about 45%. That's versus 17% across the OECD. So if infrastructure don't keep pace with the population growth, productivity suffers. Next thing, we've got to then unlock the financial capital to actually fund that business investment. Recent data shows that Australians, over half in fact, of our personal wealth is tied up in real estate. And we hold just 11% of our wealth in financial instruments. So think things like stocks and bonds. That compares with 37% in the US. And this phenomenon is also reflected in bank lending. Back in 1990, 2/3 of credit went to businesses. Now roughly 2/3 goes to mortgages. So if we don't tackle housing affordability, savings are going to keep flowing into unproductive property. And lastly, we've got to have a frank conversation about the public sector, about public services and the non-market sector. Healthcare, education, public administration, those industries, as they're defined and measured currently, they're less productive than the market sector. At the same time, their share of the economy has risen pretty sharply in the last 15 years. So it's great that as we've become richer as a society, we can and do spend more on public institutions and providing support for those who need it. But to sustain that in the long term, without just leaning on higher taxes, we need productivity growth. So we want to see more investment, more technology adoption, and reg reform that ultimately raises efficiency for everyone.
Thank you, James, for sharing your valuable insights. As we move forward, it will be interesting to see how we harness the momentum created in the market by the rate cuts and tackle the productivity challenges coupled with advancements in AI.